What if I told you one simple move could slash your portfolio volatility by 50% while still letting you chase those big returns? Sounds too good to be true, right? Well, stick around, because that's exactly what we're breaking down today. Hey everyone, I'm Alex. When I first started my ventures, my personal portfolio was an absolute roller coaster. I'm talking crypto, individual stocks, and a huge chunk of founder equity. It was exciting, but also incredibly stressful. The ups and downs were distracting me from what really mattered, building my business. That all changed when I added a modest allocation to low-cost index funds. Suddenly, I had this smooth, predictable baseline of growth. It was like putting a shock absorber on my finances, and it freed up so much mental bandwidth to focus on my company. Today, I am going to share 3 powerful index fund strategies that you can implement right now to bring that same stability to your own financial life without giving up on the high-growth opportunities you love. These are the exact methods I used to build a more resilient portfolio while navigating the chaos of entrepreneurship. So, let's dive into the first strategy, which I call the Course Atlight approach. Think of it like the 80-20th rule for your investments. The idea is to build a strong, stable core for your portfolio and then use the rest for more speculative satellite investments. For the core, which will make up about 80% of your portfolio, you'll use broad, total market index funds. These are funds that track the entire stock market, giving you instant diversification across thousands of companies. Think of funds like VTI, which tracks the total US stock market, or SCHB, another great low-cost option. By putting the majority of your capital here, you're essentially betting on the long-term growth of the entire economy. It's a slow and steady, proven strategy that provides a solid foundation. Now for the fun part, the remaining 20% is your satellite allocation. This is where you can take your higher risk, higher reward bets. This is your playground for things like your founder equity, crypto investments, individual stocks you're passionate about, or even sector-specific ETFs that you believe have huge growth potential, like clean energy or AI. The beauty of this structure is that it gives you the best of both worlds. The stable 80% core cushions you from the wild swings that can happen in your satellite investments. So, if your crypto holdings take a nosedive or a startup investment goes south, your entire portfolio isn't dragged down with it. Your core keeps chugging along, providing steady growth. At the same time, that 20% satellite portion still gives you the opportunity to chase those outsized, life-changing returns. You get the stability without sacrificing the upside. It's a disciplined way to manage risk while still embracing your inner risk-taker. All right, moving on to our second strategy, which is all about automation and consistency. Automatic dollar cost averaging, or DCA. This one is a game changer for busy people, and let's be honest, who isn't busy? Here's how it works. You set up a recurring, automated transfer from your checking account directly into a commission-free brokerage account. Platforms like Robinhood, M1 Finance, or Fidelity are perfect for this. You can start with any amount that feels comfortable, whether it's $100 a month or $1,000. Let's say you decide on $500 per month. Once that money hits your brokerage account, it's automatically invested into a pre-selected fund. For maximum simplicity, I recommend choosing a target date fund or an all-world fund. A target date fund automatically adjusts its risk level as you get closer to your target retirement date, becoming more conservative over time. An all-world fund gives you global diversification in a single package. The key feature of both is that they automatically rebalance for you, so it's a true set-it-and-forget-it solution. The magic of dollar cost averaging is that it completely removes emotion and guesswork from investing. By investing a fixed amount on a regular schedule, you automatically buy more shares when prices are low and fewer shares when prices are high. This smooths out the impact of market volatility over time. You no longer have to worry about timing the market or agonizing over whether it's the right time to buy. The system just does it for you, consistently building your wealth in the background. This discipline is crucial. As entrepreneurs, our income can be lumpy. We might have a great month followed by a lean one. An automated DCA plan ensures that you are consistently investing, regardless of market sentiment or your own fluctuating income. It builds a powerful habit that pays massive dividends in the long run, literally. It is the financial equivalent of going to the gym consistently instead of trying to get in shape with one heroic workout. Now for our third and final strategy, which is all about being smart with your taxes using a tax-efficient cash sweep account. This is especially powerful for founders and the self-employed because as your business becomes successful, taxes can become one of your biggest expenses. The concept is simple. You prioritize filling up your tax-advantaged retirement accounts with low-fee index funds. The two main accounts to consider are a Roth IRA or, if you're self-employed, a solo 401k. Let's start with the Roth IRA. With a Roth, you contribute money that you've already paid taxes on. The incredible benefit is that all the future growth and withdrawals in retirement are completely tax-free. Imagine your index fund growing for decades and then being able to pull all that money out without giving a single dollar of it to the taxman. It has a huge advantage that provides a cushion against potentially high tax years when your business is really profitable. Now, if you're self-employed or a small business owner with no other employees besides a spouse, the Solo 401k is an absolute superstar. It allows you to contribute as both the employee and the employer. This means you can contribute significantly more than in a traditional IRA. For 2025, the contribution limits are up to $66,000, depending on your income. You can make traditional pre-tax contributions to lower your current taxable income, or you can often choose a Roth option within the Solo 401k for tax-free growth. Just like a Roth IRA, by using these accounts as the primary home for your index funds, you're essentially creating a powerful financial shield. The tax-free or tax-deferred growth supercharges your returns over the long term. Think of it as a separate, protected pool of capital that's growing efficiently, completely insulated from the tax implications of your business's success or a future sale of your company. It's a strategic move that separates your personal long-term wealth from your business operations, giving you incredible peace of mind. So, there you have it, 3 simple yet powerful strategies to stabilize your portfolio using index funds. First, the CoreSat-like model to balance stability with high-growth bets. Second, automatic dollar cost averaging to build wealth consistently and effortlessly. And third, using tax-advantaged accounts to maximize your long-term, tax-free growth. By implementing these, you can build a resilient financial foundation that supports your entrepreneurial journey, rather than adding stress to it. You get the stability you need, the mental space to focus on your business, and you still get to play the high-stakes game with your satellite investments. It's about being smart, disciplined, and strategic. If you're ready to add that stability layer to your own portfolio and want more financial hacks specifically for founders and creators, make sure you hit that like button, subscribe to the channel, and tap the notification bell so you don't miss the next video. Thanks for watching, and I'll see you in the next one.